So again, we're going to continue our discussion about Chapter 16, which is dealing with how do we report the statement of cash flows from operations. Hampton Company reports the following information in their recent calendar year. So we'll prepare the operating section of their statement of cash flows using the indirect method. If you remember from the chapter and then also from the lecture, we discussed that the only section that has a choice of either using the indirect or the direct method is the operating section. The investing and the financing portion of the statement of cash flows are reported the same no matter which way that you would choose to report it. So just to make that clear. We see here that Hampton Company, again, doing the sections for the operating section of the cash flow statement, we see that they had net income of $24,000. We get that because we look straight off of the income statement. So we see that. And then we have adjustments needed to reconcile the net income to the operating cash flow, because we see here that there were several things that they paid out or things that we have to adjust so that we understand exactly how that came about. So depreciation expense is $12,000. We're going to end up adding that back because there really was no cash necessarily that involved in depreciation, if we remember from that. And then we have the increase of accounts receivable, which is $10,000. So that is part of sales is the accounts receivable, but we haven't received the cash yet from it. So we don't want to include that in this. And so that's why we're going to subtract that out. And then the decrease of merchandise inventory of $16,000. And then the increase in salaries payable of $1,000. We are going to have to pay that. So we're going to end up adding back in $19,000. And so then the net cash provided by operating activities then is $43,000. The cash flows for the investing activities. So this time what we're going to do is we're going to use the above information to determine this company's cash flows from investing activities. The first example is equipment that had a book value of $65,300 and original cost of $133,000 was sold at a loss of $14,000. And so in order to do that, you have to reconstruct the journal entry for that. And so it would be a cash debit in the amount of $51,300 because that's what we actually received. To figure that out, you just take the amount, the book value, subtract the loss of $14,000. That gives you the amount of cash that you actually received. And then the accumulated depreciation was $67,700 debit. We get that by taking the original cost, take that, and then subtract from that the book value. And then the loss on the sale of equipment, they told you was $14,000 debit. Then you would credit to equipment $133,000 because that's the original cost. So the amount of, and then we would, then on our cash flow statement, we would say cash received from the sale of equipment of $51,300. Now, if we look at the next one, it says we paid $89,000 for a new truck. So we would have a debit to truck, the amount of $89,000 because we're receiving an asset, which is a truck. And then we paid cash, the amount of $89,000. So cash paid for new truck, negative $89,000. Remember negatives, when we do that in accounting, we're going to enclose it in parentheses. And then letter C, we sold land that cost $154,000 for $198,000 cash, netting a gain of $44,000. So we have cash in the amount, debit in the amount of $198,000 because we're receiving cash. We have gain on the sale of land for $44,000, and then the land credit for $154,000. And then D is a long-term investment, and then we can include that, the cash received from sale of land. We can include that in the cash flow from investing activities. And then the long-term investments in stock were sold for $60,800 cash, yielding a gain of $4,150. It's going to be very similar to what we did in C. So we have cash debit, the amount of $60,800 because that's the amount of cash we received. The gain on sale of long-term investments of cash of stock, 4,150, and then the long-term investment stock, 56,650. And again, you can figure that out, the cost of the stock originally, by taking what they received, subtracting the amount of gain. That gets you the amount that the stock actually was. Okay, so then we can list that, and then we can go ahead then and total the net cash provided by investing activities is $221,100. Okay, notice that these are not operating activities. These aren't involving the sales or the operation of their business. These are all things that they did, either in the case of the stock, they're trying to invest their money so that they can gain, more money on it, or they purchased a piece of property that they probably were going to do something with. They obviously maybe decided not to do that, so then they sold the land, and then they purchased a truck that they needed, for their business. Okay, so, and then equipment, they sold equipment because maybe they did that because they're going to bring in another piece of equipment, or it was a piece of equipment that they now no longer were using. So these would all be considered investing activities of the business, doing the cash flows for financing activities. So we'll use the above information in order to determine the company's cash flow from investing activities. And so the first one is the proceeds from the issuance of stock, and we see that in letter B, because with $64,000 in cash, we had to pay a cash dividend of $14,600. Again, that's a cash outflow, so it's a negative. We surround it in parentheses. We had to repay a notes payable in the amount of $50,000. Same thing. That is a negative number because it's a cash outflow. And then the purchase of treasury stock, same thing. It's a cash outflow of $12,000. And then the net cash used for investing activities then is $12,600 negative. Now, you notice that there's a couple of items there that we did not report. So you notice that the net income, we're not going to report that because that is considered part of operating. So that would go on the operations section. And then you see here also, we didn't put on there purchased equipment because the equipment, that is considered an investment activity. So it is, one of the things is, it is really important to figure out exactly, when you're looking at these transactions, to figure out exactly what type of activity it is. Is it either an operations activity, an investment activity, or a financing activity? These would all be examples of financing activities because it's bringing money into the business, either through ownership, which would be stocks and bonds, or through a debt, which would be notes. So anything like that, you just have to figure out exactly what type of activity it is, and then that will help to guide you then as to where exactly you place it. And prepare our entire statement of cash flows using the indirect method, which, remember, the indirect method, it only would affect the operations section of this. So we have the following financial statements for ICABAN, for the income statement, and then also a balance sheet. And then we have a list of some other transactions that maybe wouldn't be listed here, but that we need to include as well. And so the first thing is we have cash flow from operating activity, and then remember, investing and then financing, and then net increase in cash. So we look at our income statement, we see that they had net income of $99,570. We just pull that right off of the income statement. But there's some things that we have to add back to it. So we notice that the depreciation expense we add back is $58,600. The gain on the sale of equipment is $2,000, but we're going to subtract that here because that right now is included in net income, but it would actually, that would go under an investing activity. So that'll be listed later. And then if we look at the balance sheet, we have an increase in accounts receivable net. And again, you can just look at that. You can look at 19, look at 18, and what's the difference for that is 14,000. So we would reduce that because that sales, that's going to be included up in this net income, but we haven't received a cash yet for it. The decrease of inventory, 22,700. The decrease of prepaid expenses of 1,000. Decrease in accounts payable 5,000. Decrease wage payable 9. Decrease of income tax payable 400. So then we get the total of all of these is 51,900. So we have the net cash provided by investing activities of 151,410 because we add 51,900 up here to the net income. And that's how we get the total cash that was provided by operating activities. Next, we're going to look at investing. And again, we have some new equipment and then we received cash from the equipment, D. So we paid cash for equipment in the amount of 57,600. And that, it's because for that, it's a cash outgoing. And we see that with these, and these that are cash outgoing, it's going to be a negative value. So we have that. We also then have to include and figure out that we received cash from the sale of equipment that had a cost of 48,000 yielding a $2,000 gain. We figure out that the book value of the equipment was 8,000, 48,600 minus 40,600 of the accumulated depreciation. Since we sold it for a gain, we know that we had a cash receipt of 10,000. So we have cash received from equipment 10,000. The book value on this machine was 8,000, and then they sold it for a $2,000 gain. So that's, we know they got 10,000 for it. So then the net cash used by investing activities then would subtract from this 47,600. And then we have some financing activities yet. So we paid cash to retire notes of 30,000. We had cash received from a stock issuance of 60,000, paid a cash dividend of 90,310. So the net cash used for finance activities is 60,310. And so the net increase in cash, then if we take this amount right up here, 151,410, subtract 47,600, and then subtract 60,310, we get the net increase of cash 43,500. So then we had a cash balance at June 30 of 2018 of 44,000. So then the cash balance at June 30th of 2019 should be 87,500. And then we see that that matches the balance sheet. So we know then that everything then is correct. That is analyzing cash flow on total assets. So a company recorded average total assets of 1,240,000 in year one and 1,510,000 in year two. Calculate its cash flow on total asset ratio for both years. And so to do that, you're just going to take the net operating cash flow divided by the average total assets. And so if we look at year one, we see 102,920 divided by 1,240,000 gives you a cash flow on total assets of 8.3%. And then you can do the same thing then for year two, comes out to 9.2%. Now we'll talk about using the direct method to do cash flow for operations. And so we see here for each of the three separate cases, use the information provided about the current year operations of Shaheen Company to compute the required cash flow information. And so we'll compute the cash that was received from customers. We see that we had sales, and then we had the accounts receivable balances. So we reconstruct the entry, and you see that you had cash, the amount of 508,600, because the difference in the accounts receivable was 6,400, when you had total sales of $515,000. So the cash received from customers is 508,600. Now, the total cash paid for rent is you have rent expense $139,800. The rent's payable, the difference is $101,600, and in cash $141,400. So that's what you paid in cash for the year. Compute the cash paid for merchandise. So you have cost of goods sold of $525,000. Merchandise inventory, which is what is left, and again, the difference of what is left for each year is $28,200. Accounts payable in the amount of $15,300. Cash, the amount of $481,500. So that's what you try to figure out, is how much cash you actually paid for your merchandise. Go ahead and prepare the actual statement of cash flow using the direct method. So again, we're looking at the same thing, ECABAN, but this time for the first part, it's going to be the direct method. So the cash flow from operating activities, investing activities, financing activities. The first thing is looking at, you have to do some journal entries, look at them. So you have sales. So you had cash, the amount of $664,000. You have the accounts receivable net, $14,000, and then sales $678,000. So you see that they had the sales, but the thing is they haven't received cash yet for all of the sales necessarily, because they still have an accounts receivable when you look at the balance sheet. And again, it's the difference between each of these years. It's how much is still is from that. So receipts from customers, $66,400. And then we have to figure out the payments for merchandise. So we have cost of goods sold, $411,000. Accounts payable, $5,000, and then inventory of $22,700, and then cash of $393,300. So we have payments for merchandise of $393,300. And then we have other expenses of $67,000. And then we have wages payable of $9,000. Prepaid expenses of $1,000, cash $75,000. So then the payment for other expenses is $75,000. Again, we're just concerned with the cash outgoings or cash coming in. And then we also have to figure out our income taxes. So we have income tax expense of $43,890, income tax payable of $400, cash then $44,290. So then you can total that up, take the cash receipts, subtract the payments, and that's how you get the net cash provided by operating activities. And then looking at investing activities, they paid cash for equipment, and we know that's an outgoing of $57,600. And then they sold equipment and they received a cash in the amount of $10,000 for it. So then they had cash outgoings for investing activities of $47,600. And then looking at the financing activities, they paid off a note of $30,000. They received cash of $60,000 from a stock issuance. And then they paid cash dividend of $90,310. So the cash used for financing activities is $60,310. And so the net increase in cash then is $43,500. We can figure out, we can add the cash balance back from 2018. Then that should equal then what the cash balance is then, because you're adding the increase to it. That should give you what the cash balance is for 2019. And that's one way you can check to make sure that your numbers are accurate. Cash flow for operating activities. So the following income statement information about changes in non-cash asset accounts and current liabilities are reported. So we'll prepare only the cash flow from operating section of the statement of cash flows for 2019 using the direct method. So again, looking at this, we have to figure out first the receipts from customers. So we had cash in the amount of $1,797,500 and accounts receivable of $30,500. And we had sales of $101,828,000. So we take the amount of sales, which we can get right from the income statement, subtract the accounts receivable, which we can get that from the balance sheet. That tells you then how much cash you actually received. The next thing is the cost, the payments for merchandise, cost of goods sold. Again, you can get that from the income statement of $991,000. The merchandise inventory, you can get that. That's the increase from either year of $25,000, and then the accounts payable of $12,500. So then you had cash paid of $1,028,500. And again, you would put that in parentheses because that is a cash outflow. Then we could figure out your salaries expense and what was paid. So you have salaries expense of $245,535, and then you had salaries payable of $3,500, and so then you have a cash outflow of $249,035, and then rent, and then payments for utilities. And you would just have to just know that, or you could figure that out. The net cash provided by operating activities is $452,240. The statement of cash flows, the direct method, but it's just looking directly at your cash account T balances, T account. And so again, you can take everything and categorize it by the type of activity it is and by what's happening. So if you look at your cash account, so we see here receipts from customers of $5 million. So that's a part of operating. Paid cash, cash received from dividends of $208,400. Cash received from the sale of land of $220,000. That's part of your investing. Cash received from the sale of machinery, $710,000. Again, that's part of investing. Cash received from issuing stock, $1,540,000. That is a financing activity. Receipts from borrowing, that is a financing activity, $3,600,000. Then we have our cash. These are our debit. These would be positive. These would be inflows. And these would be negative. These would be our cash outflows. We had a purchase of merchandise, the amount of $2,590,000. Again, we're going to put that in parentheses because that's a cash outflow. We had payment of wages of $550,000. That would be considered, again, part of our operating. Rent, $320,000. That's going to be part of our operating. Interest is going to be part of our operating, so $218,000. And then taxes is $450,000. The payments for machinery, that would be an investment activity, so purchasing new machines, $2,236,000. Payments for long-term investments, part of our investing, of $1,260,000. Payments for notes payable, $382,000. That would be part of our financing activity. The payment of dividends, part of our finance activity, $500,000. And the payments for treasury stock, that's going to be part of your financing activities, $218,000. So then we can add up each of these, and we get that the beginning cash balance then is $330,000. So then the ending cash balance then should be $2,883,400 is what the ending balance of cash would be. Because we see that right here. This is our beginning balance from the previous year. So then once all of this takes place, that's where we would end up. And again, that's a way that you can check and make sure everything, because if that isn't what actually is recorded in the cash account, then you know that there's some kind of an error that has occurred. So you have to go back then and track where you made that mistake. And so again, you can add up and then figure that out.